Hey fellow traders, by the end of this video you will have about 80% of my personal strategy. Now if you tried any type of hedging before, you're probably familiar with the issue all of them create. About 40% of all attempts end up with a size that's so unmanageable you feel like you have no choice but to take a big loss and start over or risk the entire account. It's a metaphorical giant and a hedge trader's worst nightmare. Every giant has an Achilles heel though. We only need to look from a new perspective and use some new concepts. This is what my strategy is primarily designed for. If this is your first time here, I highly recommend starting from the beginning of the one-on-one playlist. You want to have a solid understanding of the basics because we're going to combine those parts and ideas and look at some of the more advanced concepts. I want to cover two of those in this video, with one having two variations. So make sure you stay till the end to get all the details. Let's head into the chart. Okay, I've gone ahead and pulled up the project. I've got everything set up, and we're going to take a look at things as if we had approached being aggressive. This is going to lead to our equity that we determined would start making us uncomfortable in the risk versus reward or versus exposure part two. So we're starting to get pretty close to our determined limit, and in the beginning we had chosen $20 for that limit. We also need to make sure that when we were talking about in risk versus exposure part two, that we have that little bit set aside. That's when that is going to actually start to come into play. Now, if you're a more conservative trader, you're more than likely not going to wind up with this situation too often, but it could still happen if you get a long trend, for example, and you just get a super wide spread between your hedge orders. And you're going to need to try to create advantage at this point because, ironically, by being aggressive, you are already set up for this advantage going into this next part. Now, some things are going to be kind of similar, some other things are going to be different, and I'm going to start showing you some of those things now. But first, let's take a look at our most basic advanced concept, and that's what I usually refer to as a hedge structure. So what a hedge structure consists of is any buy and any sell of equal size that are active in the market. So you have a buy or a long position and a short position. And in this example, your advantage is actually having four of those. So the first one is going to be this top half here. That's going to be your first hedge structure. The second is going to be the lower two positions together. That's the second. Third is going to be the top and bottom, ignoring the middle. So that's going to be the third hedge structure. And then we actually have a fourth as well. That's with all three together counted as one single unit. And we also have the matching other three as a unit on the other side. So that is by definition another hedge structure. So we can actually take advantage of this in a few ways. I'm going to show a couple of different examples in this video that kind of work with the next concept as well. So first, let's go ahead and take a look at what we would do to approach this type of situation here. Now, when we were talking about trading from the inside, we did refer to the middle as the strongest position. So we're going to try to wait and see if price will get above, but I know we've looked at this before, so it's going to end up coming down. So here we are, we're in our center of our position, center of basically all the action and the top and bottom. And we're starting to get that little indication that this trend might continue. We've got our indication of the rollover, the strong push down, and now we have a pretty high probability that this is going to continue because of the shallow angle of tight consolidation. Now, the thing about moving forward from this point, when we start getting near our uncomfortable limit, we're going to want to try to work with our smallest size. That's going to be the size that we started with. In this case, and in most cases, when you have about less than $300 for an account to work with, you're probably going to be best to work with that 0.01, and you're going to use the same risk size. So you're going to be working with about $3 of risk. This is going to seriously reduce trying to take on the entire size of the hedge at once, and this is Also, something that I usually refer to as an auxiliary position or an assistive position, because you're going to look at this position independently of what's in the market. Everything right now is kind of in a pinch because of that equity, so we're just going to use our smallest size, and we're assuming that it's going to go down some more and continue, so we'll go ahead and place that entry for the sell, and we're going to protect that with an equal size buy stop, just to make sure that we don't get out of control with losing any more than what we want to expose to the market. So we'll get this in as the correct buy stop setting, and we'll start to actually just treat this as a normal position. We'll try to squeeze it and kind of follow price down. You're going to get a definite push there, so we've got a very clear higher low. We'll stay just above that, and we've got another one down here, so we'll just keep trailing that down and protecting what we're making off of this clean position, because it's bringing our equity up. So that's going to be your main objective, is to just use these smaller positions to try to gain more equity. And now it's looking like the market might be reversing again on us. So now at this point, we're going to take a look at basically closing enough to where we can make an impact on our position, but not so much that we're taking too much risk. In this case, we've gained quite a bit of equity back because we worked from our strongest point, and we actually caught that position clean. So we're going to go ahead and remove that buy stop. Always want to make sure you do that so you don't get caught up in another situation later. And we're going to start closing everything out that we have open at this point. We've got a 0.03 that we're going to start squeezing against, and that'll be $9 of risk going against it, but we're going to be okay because we're halfway back. So we close out all of the ones in game, and this little one here on the bottom is not quite in game, but it's probably one of the best prices we may see that we're thinking, and definitely if it's going to reverse. So we're just going to go ahead and take the best price we can get for that one, and then we're going to close out the rest. And even though we didn't change any type of equity, we are now going to start converting drawdown into equity. So let's equalize the stop size and change it back to a sell stop, because we're protecting the bottom side. And let me get that set on a price. Can happen sometimes with sell stops. You won't get the error if you didn't set the price. So now we're just going to treat this just like any other trade. We've kind of worked our way back up some, and you'll notice I didn't have that up, sorry, but you'll notice that we had a break of our break even, and we're starting to make some gain. So this would be one potential opportunity here to actually close that trade out completely and go flat, or since we're thinking possible reverse, everything looks pretty good. It was a slow downturn. We saw the big up push, so it really looks like it could continue from this point. So we're going to try to get as much of this as we can possibly get. So we'll let it continue. Everything is going fairly well. We'll get right up underneath there. And at that point, we were only slightly below break even, so we're really in a great spot. Now we've actually made a little bit of gain. So let's say you lock that in there and you suddenly have to go to work, but you're confident. But then you come back and now you've been hedged back out. In this situation, even though you took the extra chance, you still made a little over a 5% gain on your account, even though you didn't quite get that last part right. So now you would want to go ahead and flatten everything out and just start fresh again. So we will do that, and we are good to go for a new trade. So that's one way that you can use that auxiliary position to kind of work your way back into working with what you had before. That gives your hedge a second chance. Now I've rolled back the clock to bring us back in time to where we were going to think about this a different way. Now taking a look at the overall structure, the overall time, we're mostly in an uptrend. We had that big push up, so a lot of traders are probably going to look at this as a continuation. You may also do some other things like pull a Fibonacci tool out and measure, and you'll see that you're somewhere around the midway point, which is another common entry method. So your thought process is that you want to start squeezing from here and working out of this from here. Now, you know that most commonly you're thinking, let's close out all of the cells because we don't want those to lose value. But in order to do that, we're going to have to go against the entire size. And that 0.03 is going to end up costing us $9 out of our already uncomfortable equity situation here. So that's not exactly going to be the best idea. We have a couple other ideas, and if you see it before I point it out, let me know. But first, we're going to take a look at what we just learned, and that was the auxiliary position. Now we know if we add in here, we're going to add more to our size, and that's going to end up creating a problem if we get it wrong. But it's a way to control the risk. It'll also give us one other structure point to work with later. And if we do end up getting this completely wrong, it'll take us down to only $79 and some change. So that's actually a lot better for us in the long run. But the other way and the final way that you can actually handle this is doing the auxiliary position the other way around. Now, if you remember, we did talk about structures and looking at them individually. And right now, you currently have a 0.01 that is in a gain right here. And we know that we want to risk a 0.01 because that's what our starting size was. We want to risk $3 to make this attempt. So we're going to need a 0.01. So instead of opening a new position and adding that 0.01, we are going to take a good 0.01 out of the market. And then we are going to begin to squeeze with a 0.01 sell stop right below it. And if you notice, that is exactly the same as if we added another, but instead we just removed it to accomplish the same thing. So now at this point, we can squeeze and look at this as just an independent position, that 0.01 that we just swapped around for. You notice we're exposed by only 0.01, so we're only exposed to this negative position by 0.01. And that's going to really keep our risk in check. So now we can go and trail this up and see how much we can get out of it. Now you could take it at any point, but again, we're thinking this is going to be a push up. We're thinking that this is the retracement and this is the end of it. So we're just going to continue following that up. But instead, it snaps right back down on us off of this level here. And now we're back hedged. But we have the exact same size as before. We've kept everything under control. And we've also picked up a little bit more equity by using that little small position. But now if you're taking a look at everything, you want to let it settle and you're starting to notice that this is an overall downtrend. So you're going to try to hit the retracement of the downtrend, the most likely possible reversal point. So right now we have price that came up into that significant level that we had picked out before. It's showing pretty well. And we're starting to get a little bit of a double top that's sloping down. So that's a pretty good sign that we may want to sell. Now, in this situation, since we're already assuming down, and the only thing we have in a gain are the down directional positions, we may want to stick to either adding one more auxiliary position, or you would need to wait for the market to try to reverse the other way. But let's go ahead and add in our additional auxiliary position. Since we picked up a little bit over 6% risk, we can actually go ahead and go a little bit bigger and be more aggressive to try to get out of this if we wanted to. Now, again, this will increase your size by a little bit, but I'm sure you've probably noticed by now that we can actually control how much we're risking no matter how big this size gets. And that's actually the Achilles heel in the market. This way you can do to the market what it's always trying to do to us. So let's go ahead and finish this out here a little bit. We're going to work it a little further. And we've added in an additional auxiliary. We're going to try to pick up some more gain here. Make sure it's a buy stop, the correct type. And we're just going to try to squeeze that down and lock in whatever we can. And we'll follow that down just in case it pops back up, because it does look like a stronger sign of a double bottom now at this point. But instead we ended up getting hedged out. And at this point, we are now up to 93.42. So we've only got $6.58 to go. So in small little pieces, you can gradually cut this giant down until eventually you can get out of it and flatten everything. Now, you don't have to worry about all of these different positions. We're still holding. And one thing to note is swap fees are not very expensive in comparison to what you're trying to do. And then you also have the fact of compounding. So a lot of times these swap fees will not become a major factor until you get to be significantly larger than even this. You notice that right now that giant is getting larger, but so are we. So we have this sorted by type. We are now at a 0.05 for both sides. And then to repeat, if we're thinking that it's going to go, but then all of a sudden it just starts gaining momentum, so we don't take that trade. We kind of watch again and see what's happening. And here's another good thing that I like to look at. Notice how each time there's a little bit of a pattern in the volatility. You have some smooth candles. They'll have fairly consistent sizes, fairly consistent tails. They may get big or small, but they're relatively together. But then when you start getting this choppy stuff, everything changes out, starts getting a little bit more extreme. You get a hard push, but then there's no momentum going out. Then you get these nice little block stacks like this. It's usually a good indication that the volatility change is going to make the market turn. I really like that entry indication too in price action. And it's not necessarily just this specific type, it's any kind of other real change in volatility and in the volatility pattern. Notice how it started going there and rolling, and then we got the steady and gradual increase here, and then all of a sudden when we got to that level, notice all the tails. Everything got way more volatile. That's the change in the market. That's usually your first sign that something's going on. And now from this point, we have that down here. So let's go ahead and try to apply that. And we're going to keep doing our same thing. Since we have all of our sells on one side and we have a buy on the other, we don't want to do anything with the buy because we're about to gain that back. But we don't want ourselves to lose value. So at this point, you may decide, okay, I've got a little bit better risk. I'm doing pretty well. We're on a roll. So let's find our best sell, and we'll sell 2 of those, or close 2 of those. And actually, that would be a very good one to take. It's our strongest one, so we will just simply close out the entire 0.02 because that's what we want to expose ourselves for. And do the same thing. We'll do a sell stop right below and trail it up until we are in the clear. So I'll go ahead and place that order there, and we will begin to squeeze. Get that out of the way and see what we can come up to here. So we'll kind of follow that up a little bit. And there it is. We finally have not only success of getting rid of this giant, but we also made a gain doing the same thing, just repeating that small process of maintaining control of the risk, using that auxiliary position either in an add-on type way or in the way we just solved this with a removal type way. And now you see we got rather large, but that monster is down. And that is what the whole purpose of the setup and the different levels and trying to look at things from a different perspective and just piecing out parts of your risk. That's what you're trying to do. Just simply do to the market what the market does to us. We're not quite finished with the series yet, but give yourself a round of applause for making it this far. I know we covered a lot of things in this video, and we also covered quite a bit throughout the playlist, but you should now have enough technique to handle most situations. I hope after seeing the video you can see just how being aggressive can be very helpful when applying the advanced ideas. By being able to look at individual and combined structures, you have many more ways to control and manage the risk. There are still a few more advanced concepts to come, and those will be in future videos. With what we've learned up to now, though, should be quite a bit to help you out in just about any situation. You may get quite a large size over time, but you can continue the same process of using removal or addition to make the auxiliary position until eventually that giant falls. Now, how big is too big is going to depend on your broker, but in most cases, it's a lot larger than you think. The biggest factor in that is just going to be how much is your broker charging for swap sizes, but usually they're small, and because we're compounding, it's not going to have much effect on us over time. Now, one thing to keep in mind is prop firms and challenges may not have room to handle this type of strategy, and it may require a little bit different approach. That's one thing I plan to explore here pretty soon. For now, just practice, 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 because there are only so many possibilities that one set of data can cover. Other pairs may present some other unique situations and may also give you some new ideas. Just be sure to experiment with your style and these concepts, and you'll eventually find a fit for you. I'll show more of what I do here coming soon. Now, before I wrap things up, I want to thank everyone for their support, and I really hope this series has been helpful to you. There are a few more videos to come, and then we're going to start exploring any number of new other trading skills. So be sure to subscribe to get notified when I upload a new video. I'll see you in the next one.